Happy Friday and welcome back to yet another live event where we unpack underwriting, due diligence, and capital allocation, risk management, one step at a time. So, first of all, I am extremely excited today because I've had quite a bit of engagement over the past couple of weeks with many of you through DMs, interactions through my newsletters that I publish, one being the Underwriting Minute, covering all things on deal analysis and multifamily, and the second one being the family enterprise brief that is more focused around governance, succession planning, risk management within the family enterprise and family office. So, first of all, thank you for all the questions. And I have started covering some of those in the form of longer form responses in the form of articles. Others I want to cover during the live event, and those requiring deeper uh, deeper dive, so to speak, I will likely also cover in one of the future newsletters. But I did not want to delay the responses because you are asking great questions, very relevant questions, very timely questions, and they deserve their space and their highlights. So I will stay within the usual length, but in the responses, tap reply and let me know if you'd like a longer format. And I'm happy to stay longer and address additional Q&A, either live or simply continue to cover what you've already shared with me privately via messages, DMs, and calls. So if you like the longer format, simply let me know. I'm happy to accommodate. But for now, we'll stick to the traditional 10-minute or so length that we've had. Again, I do these pop-up lives every Thursday and or Friday afternoon, depending on schedule. And for those who may be tuning in for the first time and haven't met me, my name is Vesica Pulyan. Spent the preponderance of my career in risk management and commercial lending, managing a pretty sizable credit portfolio north of $1 billion today, where I spend most of my time is advising founder-led enterprises, their family offices, as well as high net worth investors on risk management, due diligence, and governance, and protecting the downside during the capital allocation process. So without further ado, I want to dive into the first few questions that I received. And again, I will probably cover a couple and then we'll continue those next week and the week after. So, the first question is, what are your thoughts on underwriting a property that has occupancy below what is needed for agency debt and rents are lower than comps? How do you most accurately build a pro forma that needs to increase pricing and occupancy simultaneously? And another reader asked a similar question, again with respect to the renovation process and factoring in the economic vacancy in a value add project. And I love this question because it actually covers a lot of different aspects of the deal analysis. And what it really boils down to, especially in properties that require more tender love and care to get stabilized, is what I call the sequencing approach, and how I would stage it, not only from an operations perspective, but also numbers and modeling perspectives, is really in two phases. Phase one is what I would call focusing on the basics. In other words, getting the units occupied with qualified tenants in order to get to that 90+% occupancy level that the agencies or local banks and lenders will typically require before they refinance and take out refinance the property and take out the bridge loan. So getting to that 90% occupancy is key, especially if you're inheriting a property that was not optimally managed. And again, the goal is to fill it with qualified tenants, not just have the what was not in the industry as heads on beds. Yes, you may have the heads, but if they're not paying rent, or if they're consistently late on rent, it ultimately impacts your collections, right? How much cash you collect every month, and all that flows to the bottom line. So you don't, the worst is actually having occupied units that are economically vacant, meaning you're not able to collect the rent at all. And even worse, if you have to evict them and then go through additional expenses in order to get that non-paying, non-complying tenant out. So step one is focus on getting the occupancy. How long does that take? Really depends on the size of the property. So you really want to be realistic about that in your expectations. A lot of it is also predicated on the state of the market as well. Actually, Barcadia just released its quarterly report, so you can see in certain markets. I was reading just out of curiosity, right? In Nashville, for example, in many sub-markets even within Nashville, right? The those locations are still struggling with absorbing the supply overhang, and so because of that, not only the occupancy is still soft relative to historical standards, but also the rents in many places are declining. And so that brings me to the second point is, as part of that question, what type of how much rent can you charge? Well, again, in the beginning, try to get as close to market rent as possible. Forget about charging any premiums, because again, your goal is to get to that 90%, so you actually have some cash flow starting to come in versus sitting in with a bunch of vacant units. And you want to do this as expeditiously as possible. So taking 2 or 3 months longer to lease a property because you're trying to get higher rent is also hurting you, right? Because these are 2 or 3 months that this property is now sitting vacant. So taking into consideration the local market conditions is three. So that's phase one. And then phase two is where you're actually now looking to start maximizing those rents. So during phase one, especially if you determine, for example, hey, the market really requires XYZ upgrades. We have these vacant units sitting now. So we might as well bring them back to standard, so to speak, a standard that a prospective tenant would require before moving in. That is the time to do that. And then in phase two is where you really focus on pushing the rents, and maximizing the top line. And the larger the property, again, the longer it takes, because now in phase two, you're waiting for these leases to mature. Typically, they're 1-year leases, so you can't necessarily start this sooner before the lease term, unless, again, you're evicting a tenant. And that's what a lot of models I see don't often factor in. There was a property that I was looking in, exactly that scenario that required a heavier lift, and they had assumed like basically pretty sizable, I don't remember off the top of my head, but it was a pretty sizable number of units being turned every month. And it wasn't even clear, to me, I don't think the work was done based on the speed of the turns. That they had looked at when these leases actually mature, because you can't just start turning a unit while the tenant is still in there. Maybe with advances in technology, and depending on how much of an upgrade you're doing, maybe you can, but that wasn't the case in that particular deal. What you also have to factor in is not only the top line, but also the expense side of the equation. And so, for example, in the beginning, let's just say if you have a utility reimbursement program in place, well, you're not going to be reimbursed for any utility expenses for the vacant units, but utilities still need to remain on, whether you're turning the unit or showing it to prospective tenants. There are switchover expenses when it comes to utilities that you have to factor in. It goes without saying that the turn expenses will be higher during that initial transition phase, especially if you're going to be doing additional rehab work. So that also needs to be factored into the equation, and then any other additional capex that you have to factor in for curb appeal and whatnot. So during the especially for properties that are below 90% occupied, you're likely not going to be cash flowing. Again, really depends on where your break-even occupancy is, but when you factor in the higher baseline for expenses and then the lower occupancy, you can almost bet that if you're say 80% physically occupied, you probably have another 5 to 10% economic occupancy, whether that's concessions, promotions, and whatnot. You're probably cash flow negative at that phase. So your goal is to get to cash flow positive positions as quickly as possible. First, get the occupancy with qualified, emphasis on qualified tenants, upgrading units if required by the local market. And in phase two is where you start burning off some of these concessions, promotions, and maximizing rents. So really appreciate the question. Question number two, I actually got a couple of questions related to AI, specifically how can underwriters effectively balance AI assisted decision making with human judgment, especially when evaluating complex and non standard risks? How I use technology and AI in my base business processes and risk management as it relates to AI. And I actually wrote an article on the subject specifically as it relates to deal analysis earlier this week, and I had a live event not too long ago on how I use AI in my processes. But I do want to address this question because it is relevant, very, very timely, very frequently raised by investors, and AI is very quickly evolving. So I think it deserves its own space. So the main premise in the recent article that I published, and if you'd like a copy, let me know. I'll share the link with you. Is that AI can be a great, great tool. One, you can outsource a lot of the repetitive, administrative, mundane tasks, and it is great at doing these kinds of jobs. But the key is you have to train it well, right? Because the inputs determine the outputs. You also have to have the knowledge and experience of underwriting deals, which is why I'm a big proponent of education and why I have the course and community where I help people underwrite deals from A to Z. Because if you don't really understand the essence of the material, if you don't really understand how a deal is analyzed, if you don't really understand where the stressors are, you become a consumer, solely a consumer of information, and the output of AI will look very professional, very glossy, but you really need to know where to poke the holes, not only to train it, but also to identify the gaps and areas that deserve closer attention. Um, AI, again, can be a great tool to enhance your productivity, but it is not one that can necessarily, or should not be, I should say, should not be one to replace the human element of judgment and discernment. And especially as an investor, whether you're allocating capital on behalf of other investors or on behalf of yourself and your family, you have a fiduciary responsibility, right? At the end of the day, you are the one writing that check. You are the one underwriting, pushing that wire out. Not It's not AI. So any consequences of poor judgment or poor decision making, not validating the information, not stress testing the assumptions, any consequences of that would fall on you and your partners or your loved ones. Is a great tool to use to widen the search. I use it. I've developed a couple of GPTs and skills to assist me with some of the preliminary analysis, so I can more quickly kill the deals, right? That don't deserve my time and attention. So you can use it to widen the search, but not necessarily shorten the work. And again, the danger is in often in trusting a well formatted answer. AI can look very clean and very polished and make the answer appear really well formatted, very well stressed. But before relying on any output, the test is simple. Ask yourself, what did AI assume that no one checked? Where are some of these gaps? Because if you have that discipline underwriting process, it gets faster and more efficient with AI. But if you haven't really mastered the basics, then a sloppy process not only will get produced fast, but will now look very polished and convincing on paper. So you really need to understand which assumptions drive returns, what are the key risks of the deal, how they're mitigated, are they realistic, do these numbers support the story, do they align with the local market. These are all questions that you have to ask and push further. Now another aspect, specifically as it relates to the risk management of AI. So we talked about the data integrity, we talked about the fiduciary responsibility, and then the third aspect when it comes to one of the risks is the confidentiality and data management. I mean, a lot of the models say, right, if you subscribe to the paid version, now it's private to you. You can turn off training and whatnot. But the truth is, we really don't know where this data resides. And so you have to be very careful what type of information you push into it, especially if you're doing private deals that are often subject to NDAs. It's not recommended that you publish information there, and otherwise it can be accessed. There was an incident actually of a lease, I think it was a lease abstract that someone had prepared, and it turned out it had the name of the company, like the name of the vendor, the name of the customer. It turned out that after some investigation, it was not something that a company had published, but perhaps an employee using AI had published a template that got reused somehow and basically made its way to the public. So pretty scary stuff. And also what you share with AI um, is not exactly private. Just like email or text, it becomes discoverable material. And I was actually surprised how many people don't know about that. But if any of you watched the recent deposition that Grant Cardone kindly actually shared, so credit to him, he shared all of it online. And one of the attorneys was asked a very crafty question. Yeah, how do you use AI? How often do you use AI? Have you used AI for any of this deal work? They were questioning him on a specific deal because they knew that if he said yes, all of that becomes now discoverable material, and they can gain access, right, to his AI. So be very careful what you publish there, or at least I'm not quite ready yet to outsource everything. Again, I know there are a lot of agents and whatnot, but especially if you work with privileged data and information, that's where to be more careful, because you may also be liable. So it's not only the confidentiality aspect, but there is also the liability. I'll cover two more and then I'll stop right there. I'm really enjoying it. So one is the exit cap rate. One reader was hesitating around how to model that and what the right amount of exit cap rate expansion is. I've spoken at length about cap rates and happy to share with you links to articles and live events that I've had on the subject. But very quickly, effectively, the exit cap rate assumes, right, that the market will get worse before it gets better, and it builds additional cushion in the deal. And the answer to how much cap rate expansion do you assume really depends on the current market environment. So if you had asked me this question back in 22, 23, I would have said 200, 250 basis points, right? Because I, in up until early 2022, we were in a very low rate environment. And even when the rates started hiking rates, I mean, it raised rates pretty rapidly over a short period of time. Um, but we were coming off of a really, really low base. So at that time, I think increasing the exit at around 200 basis points was appropriate. And that's more or less where we're at today, right? Going from the 4 to the 6 cap environment. Now, if you ask me, what do I do today? I don't increase it 200 basis points, but maybe 50 basis points. And in some markets that are particularly strong, like in LA, for example, maybe I would be open to keeping it flat at the time of exit, but certainly not declining. So 50 basis points is conservative. Again, does it completely cover you for the risk? Not exactly, because if cap rates increase 100 basis points, you're still going to be short, but at least you've accounted for 50 basis points of the 100 basis points increase. And last question, do you represent buyer or seller mostly when you underwrite a deal? And if you've done both sides, what is the difference between the two, if there is any difference? So most of my work centers around the allocation of capital. So that is the buyer side. And I help a lot of investors with second set of eye deal reviews, specifically in apartments, though I've done other asset classes as well. And then on the family office client side, the scope is a little bit larger. In that case, we often look at buying businesses, buying companies, and I've structured M&A deals before, done diligence on that. So I have the experience from my former commercial lending and risk management and underwriting background, as well as a couple other asset classes under my belt. So I've helped with those, but the majority of the work revolves around the front end of the capital allocation. Now, in some cases, I do get brought in the middle of a deal whenever there is pause distribution or capital calls. Sometimes I've been deals where there have been multiple capital calls. So happy to take a look and help you work through the decision making process, because the capital call is, I view it very much similar to evaluating a new deal. Why? Because even though you are in an existing deal and you have now some of the history of the deal, you're allocating fresh money, new money to the deal. When it comes to seller representations, I have contacts within the industry I can connect you with, but for those types of analysis, the work really begins at least a couple of years before the sale, right? To position the property for sale or to position the company for sale. And it really boils down to day-to-day operations and asset management. So I'm happy to share thoughts, but there are actually consultants who specialize in that. And if you need help connecting with those, I'm happy to make an introduction. So I went over time, but you guys had wonderful questions, and I really wanted to give them the time and space that they deserve. I have received several more over the past couple of weeks, so we'll keep on going. The next set of questions really revolves around the red flags in analyzing deals or telltale signs of fraud. So we'll cover that. And then in the live after, they're mostly centered around family office, capital allocation, and evaluating deals within the family office circle. So we'll center on that topic. So I hope you can join me and keep the questions coming. I appreciate you and I wish you a beautiful day.